Thanks everyone for agreeing to stay here, not hear the crypto crime or the cyber crime discussion and to brave the snow to be with us today. So looking forward to the conversation, Ryan.
I am as well.
We had some time to prepare for this over the last week or so, and I expect a very active 40 minutes of conversation. So, Ryan, one of the things that you and I chatted about as we were preparing for this is, let's level set what we mean by digital assets, because there's many different conversations that are being had now about the topic. There's the business conversation, there's the technology conversation, there's the policy and regulatory conversation, and a lot of the conversation is about crypto, Bitcoin, stablecoins. Now, that's relevant as a digital asset topic of conversation, but it's not the only way to think about it. So how do you at Citi think about digital assets? Help us put that conversation into the proper context.
Thanks, Karen. Yeah, you're right. There's a lot of different flavors, right, of digital assets. So, top level definition of a digital asset is a non-tangible asset that can be created, stored, or traded. Within that, you have several different types. So you have tokenized deposits. You have tokenized money market funds, which is a big area that we've seen recently. You have, here at trade, you have smart contracts that are used for trade, and I know we're going to talk about that later. You have tokenized securities. Then you have stable coins and crypto. So you have a whole wide range of it, and you have to separate, as you said, the technology, blockchain, from the different use cases that are being built on top of it, because it's very different.
And the real world assets that are being tokenized versus other assets like Bitcoin that are truly crypto, virtual,
native,
and digital as a native form. Okay, so we've level set with that. Hopefully you all now have a grounding for how we're going to have the conversation about digital assets. But the reason that you guys are here and not next door is because the little blurb that really introduced this panel was about payments hitting an innovation plateau. Basically, the thesis is that we really have not innovated, in payments the way we need to in order to move money anywhere, anytime, to anyone. However, I went on your website, and you guys move $5 trillion worth of money every day around the world. So something's working, right? Do you buy into the idea that payments innovation has plateaued, that things are really broken? How do you react to that particular proposition?
So I don't know if I would say we've hit a plateau, but for the most part, especially in country, payments are pretty efficient. You start seeing, but when you start having to go cross-border and having that always-on infrastructure, that matches the speed of the internet. So the thesis statement that our clients have given us is they want always-on, multi-bank, multi-border liquidity and payment.
Is that all?
That's it. Very, very simple. Very simple. Just those things. So, from the Citi perspective, we've kind of taken a two-prong approach, right? We're updating our legacy infrastructure. We've created products like real-time liquidity, Spring by Citi, 24/7. In addition to thinking about more of the innovative technologies like blockchain and how that could transform the industry. Because as you said, one of Citi's, strongest attributes is our network. We move $5 trillion a day. We have 19,000 clients. 85% of them are Fortune 500 that want payment and liquidity that match the speed of the internet. So how are we going to do that, right? How are we going to build that? So we've kind of taken a two-prong approach in addressing that.
So if we were to look under the hood, is blockchain technology absolutely critical to realizing this always-on, anytime, anywhere, to anyone vision?
So I've been in this space for 10 years. I've worked at fintech startups, I've worked at large global system integrators, and now working at a bank. It is 100% not needed if it's just within one organization. If you're just going to set up a blockchain within your organization, will it add efficiencies? 100%, but it is not needed. You could have a database with a security wrapper. But when you start to connect disparate parties on a network that don't necessarily trust one another, you do need that. And what's unique about this technology versus others, because at Citi, before we built Citi Token Services, we evaluated multiple technologies out there, not necessarily blockchain. And some of the attributes of blockchain that were really different was, one, the programmability of it, a smart contracts, which is unique to this technology. So for instance, with Citi Token Service, if my account in New York drops below 100 million, send money to Singapore automatically, instantaneously. So when we're thinking about digitizing the whole process, if it's from payments, liquidity, trade, whatever it is, automation is needed, right? So I think in certain cases, and then disparate parties, to connect multiple parties on a network, that's what this technology was developed to. Distributed, right? Distributed ledger technology, distributed across multiple parties. You need a technology through cryptography that is encrypted, that your information is safe. So I think that is unique to this technology also.
I want to pick on smart contracts.
Yeah.
Because I think everyone, realizes the potential and the power of smart contracts. And I tried to Google, how many smart contracts are used, and I couldn't find the answer to that. But Google says that there's going to be more of them. However many there are today, there's going to be more of them. My question, though, is, with the power of AI and the agentic technology, how does that reconcile with what you just described as the potential for smart contracts on the blockchain? Is Gen AI just another software layer that powers the applications on the blockchain? How do you see those two things either being complements or competing for dominance in this area?
So prior to Citi, I worked for IBM, and I sat in the emerging technology practice. So that was AI, quantum, blockchain, all the new technologies out there. And it's clear that we're at an inflection point. It's not just one technology over another. You're seeing the multitude of these technologies come together that are going to transform multiple industries, finance being one of them. So you can start to reimagine the way that we do business, where you could have a smart contract that says, and smart contracts, just a level set, are just binary code that say, if this happens, do that. It's not actually smart. So, you get forecasting from these AI models. If this happens, then do that. To really automate it, right? To think about how you can transform these industries, because it's clear the speed of money needs to move at the speed of the internet, right? We're starting to see demand from clients. We're starting to see demand from institutions. So how do we, at Citi, think about that future of networks and making sure that, we're serving our clients in the best way possible, but taking these innovative technologies and demystifying them, right? And making sure the safety, soundness, regulation, everything around it is implemented as well, because, we've seen what could happen when it's not in these industries.
Yep. Let's take a simple framework for assessing the real potential of digital assets and blockchain technology. And it's a framework that, it sounds simple. I use it a lot when I'm trying to understand whether or not innovation can get liftoff. I call it the FIT framework: F for friction, I for inertia, T for time. So I think we've talked about the friction, in terms of the anywhere, always on, anytime, safety, security, soundness. How do corporates articulate the friction that they encounter that makes digital assets and blockchain really very fundamental to how they do business?
So in my prior role, I learned that, the more you can abstract the technology from clients, especially when it's emerging from, the easier it is going to be for a client, right? So with Citi Token Service, clients log on via their Citi Direct account or through an API. You don't have to host a node. You don't have to have a wallet. You don't have to implement new technologies. I struggled with that at IBM with TradeLens, right? There was an upfront cost for the technology. A lot of in-house people didn't have the expertise to know how to run a blockchain, to scale it. So, be able to abstract the technology. So I say that's one level of friction, taking the technology out of it, just the utility, right? Because clients want always on 365. They don't actually care what technology is.
That's true.
I'm a dork. I love the technology, but a lot of people don't. So the more that we can take that away from the clients, you remove that layer of friction and that need for that expertise internally.
Right. So basically, they just want a solution.
Yes.
And you're right. It shouldn't be about this technology versus that technology, because they're not technology experts. Okay. So there's a solution. There's a business case. There's the reason to do it. But then there's the I, the inertia. Yes, that looks great, but what I have today works well enough. And perhaps it's a big lift that could create things that break. How do you get past the status quo to this new horizon, particularly when Citi is operating in a highly regulated environment and corporates are moving, their own trillions of dollars, hundreds of billions of dollars daily within their own networks and trading partners? How do you get past inertia?
So, it definitely people don't like change. As much as they want to believe they like change,
Well,
there's risk.
There's risk.
And change is uncomfortable. And who wants to take that risk? I think that no one in this room is going to argue that we'll eventually be in a real-time world, right? We're eventually going to be in an always-on infrastructure, but how do we get there and how do we do it in a measured way? So I think that, taking the complexity of the technology away, showing the utility of what it is, because clients are starting to see demand from so our clients' are starting to demand it from them. So how do they start to do it? So if you think about, the real-time, kind of environments out there, like the Ubers of the world, where drivers want to be paid in real time, and there's more of this that wants to be real time, and how do corporates match that? That being said, a lot of these ERP systems aren't set up for real time, right? So to your point earlier, for the most part, they work pretty well. But there is time for, kind of non-banking hours. So recently, during the Chinese New Year last week, we had a client that wanted to settle U.S. equities on a T+1 basis, but Singapore was closed, right? So being able to still, regardless of the bank being open or closed, still being able to use that money. So we're starting to see adoption, kind of towards that.
So adoption time frame, that brings me to my last thing, which is T. You said you've been doing this for 10 years, so we've been talking about this for a long time, right? And time can be its own currency. So you use time, you want to be able to implement new things in a time horizon that's relevant for the business, because there's always the opportunity for something new to come along while everyone is making this change that is better, simpler, faster, better, cheaper. So what is on the critical path? How do we think about the execution, the adoption at scale for digital assets and blockchain technology? What's on the critical path?
So when I think about time, it's relative, right? Because you think about one of the most disruptive technology of any of our lives, the internet, it started in 1950 with Sputnik, right? So and then it kind of in the 78 was, I think, the first email sent, and then .com, and then really the explosion of proliferating, working from home during COVID. So we're still 75 years later, we're still innovating on it, but it has completely transformed the way we share data. Via email, we went to the read-write era. So I think time is relative, but we have seen some killer use cases on blockchains, the volume starting to skyrocket. Now I think recently, stable coins as of this month, I think are close to 800 billion volumes on a monthly basis. So extrapolate that, they're gonna rival some of the larger networks like Visa and PayPal in the near term. So, when you ask about adoption, I think it's pretty clear that you're starting to see adoption in these various industries. But from our perspective, wanting to make sure that safety, soundness is still implemented in this, because for the most part, it's been retail driven. It hasn't been. It has not been institution.
Because a lot of the stablecoin volume is trading, because we're now back into a crypto spring, summer, flowers blooming, everything is great. Questions. I want to take some questions because these are good questions. Why is this so challenging to implement, which we just talked about, in international trade finance? And let's talk about that with respect to TradeLens, which you know a lot about. So little context, that was a consortium between IBM and Maersk, big shipping company, that I thought had every opportunity to really explode. 90 participants, really moving trade finance from paper-based to blockchain technology, eliminating fraud, making things more efficient. It kind of died. Why did it die?
That's a great question. So there were multiple reasons. One, digitizing bills of lading take an organizational change.
That's true.
So forget the technology. Two, governments to accept digital forms of bills of lading. Not all governments. I think recently, the UK finally started accepting it. So regardless how innovative the technology is, if the end users aren't going to be able to accept it, it's useless, right? At the time, the technology has matured. It was expensive to implement it, you know, and it was a separate system, which I've learned, like now, it has to be integrated into the core businesses. It cannot be a standalone system, otherwise it's not going to be scaled globally. 3, Maersk owning it. Like that is something that you cannot have like the 1,000-pound gorilla in the room.
It's like Amazon and retail.
Exactly.
Yeah.
You cannot have the 1,000-pound gorilla in the room where to own the network. So like when we think about at Citi, like yes, with Citi Token Services, we developed our own token, but we started with the network, like working with the regulated liability network, working with different governments to like think through this before we even had a token, but realized how can you connect to a network if you can't move a token around your own 4 walls? So I would say, you know, industry changing over time, government regulation, making sure that it's a market utility, it's not owned by one entity is key. And then it is time management. People understand new technology, get safe, write the policies around it, kind of the procedures around it. And, you know, how long and patient are companies going to be with this to invest in technology?
Well, they have to see some outcome, right? So what would you do differently?
I'm doing it differently.
You're doing it differently. Is that a scoop?
Success breeds success, right? So being able to add value day one to our clients.
Yeah.
So right now, clients do not know they're using a token with Citi Token Service. We enable it in the back. They don't have a node, they don't have a wallet, they don't have to hold tokens. We mint it in New York, we send it to Singapore, we burn it. Cash for cash. So this way, their internal technology teams, reporting team, risk team, operational, is synonymous to the business they know. So that was 1. 2, we can't own the network. Like I saw that fail with TradeLens. Like it cannot be.
So who owns the network?
Well, that's the $1 million question right now. You have multiple entities here as well as globally that are working on this. You know, Swift, you have VTAP for Visa, you have MasterCard Token Network, you have startups, Finality, Partior. There's
so networks that already exist that basically take on this responsibility.
There's ones that exist like within Swift and Visa and MasterCard. There's new ones that are fintechs like the Finality and Partiors. There's regulated ones like the regulated liability network with the Fed or the Agora with BIS. So there's a multitude of different flavors of them, but you know, one thing I know is like one entity can't own it. It has to be a utility for the industry, by the industry, with the standards that work for, you know, all.
And trusted.
And trusted, because like that was another thing. So I think that, you know, I've learned a lot. I joke off with the team. I probably know what not to do more than what to do, but from the last 10 years, I've learned a lot.
Well, you learn a lot from the things that don't work, right? Because that's how you work around the obstacles and get better. But there is the issue of scale and then interoperability. And maybe what you just said addresses both of those things, where you have to have scale, which TradeLens was never able to sort of lift off and get that ignition, but also the interoperability. So, you know, right now we see a lot of experiments in the private blockchain. You have yours, JP has theirs, I'm sure there are others. But it works within your own closed ecosystem. But for this to be always on, available to anyone, 365, all the things that we talked about, there has to be interoperability. How do we solve for that?
We've been working on a lot of projects as an industry on that, like the regulated liability network. How do the banks come together to, you know, solve this problem of interoperability? How do we, you know, in a safe and sound way? There needs to be standards across this you know, like that's what caused the proliferation of the internet, TCP/IP. You need to have standards across. You know, there was for a long time the whole debate, like which blockchain is going to rule all blockchains. I think we're past that.
Right.
You know, we happen to be on a private permission version of Ethereum, while, you know, JP Morgan is on a proprietary version of, it's called Quorum. So that, you know, it used to be which blockchain is going to rule. I think we've recognized that we're past that point. But, you know, as an industry, how do we come together? And like right now, we're, you know, participating in Project Agora also, which is working with the, you know, Bank of International Settlements to kind of solve some of these issues. So I think it's now less of a technology debate. This technology debate still exists, but it's more of like, how do we establish those standards?
How do you think about the interoperability around domestic real-time payment schemes that are also about always on, 24/7, 365, that versus what we're talking about? Are they complements? Are they competitors? Do you see a world where they both live? How does that environment look to you?
So the way I think about it is we're just developing a new set of rails. They're traditional, like, I think people still use ACH. Like, checks are still like a huge part of the U.S.
We should talk about that later, the whole check thing. That's crazy.
You know, here, checks are still part of it. So this is just a new set of rails that we're developing that has unique attributes versus other kind of rails, where you could have atomic settlement or delivery versus payment on the same network. So assets and money settling real time, not messaging, right? So I think that this will be just a new set of rails that exists out there. I don't think that, you know,
They're not replacing.
they're not replacing. And
We don't replace things in payments, have you noticed? We just keep adding.
We just keep building.
More and more and more. Where does the role of regulation fit here? I mean, is that the elephant in the room, particularly when you're talking about regulated institutions like banks versus some of the other digital natives that are also looking to innovate in this area? There's obviously a hearing today on Capitol Hill about stable coins. Who needs to be at the table in order to get what needs to be done from a regulatory and policy perspective moving in the right direction?
Yeah, it's a very dynamic environment right now, and we want to make sure that, you know, Citi has a seat at the table and that we're innovating in a way that is safe and sound for our clients. And that is why we've looked to like these public-private, like, you know, I would say initiatives, like with the Fed innovation, with the RLN, with Agora. There's 7 central banks there, but to make sure that we're innovating in a way that, you know, fits our clients' needs, but also, you know, having our legislators understand how, like, the frameworks, the governance that we've put in place for decades is needed in this market. This is just a new asset class, right? It's not, you know, a new way of moving money, a new way of moving value, but it has to be safe and secure, right? You know, we can't have, you know, we move $5 trillion a day. Our clients rely on us.
Right.
And we have to make sure that same rigor that we put around, you know, current is on this new digital assets. And I would say, you know, from building Citi Token Service, like, we've even added an additional layer of scrutiny around it because it's emerging technology, right? So all the traditional KYC, AML, sanction checks, that does not change just because of this new asset class.
How do we solve for the risk and liability in an environment where it's always on, you know, there's counterparty risk, but things are moving instantaneously? I mean, if you think about where we are today in many aspects of payments, it's he who holds the risk and liability kind of decides the rules. Where does the risk and liability conversation have to happen in order to get these kinds of rails ignited to their fullest capability?
Yeah, we think a lot about risk, especially in this kind of new emerging technology. And that's why, first off, currently, it's only offered to Citi clients. Like, we are not offering, so all the KYC process that we normally go through to onboarding, you know, is still there. You can send money from, you know, like, I can send money from Ryan to Karen, but I'm not sending it to an illicit third party that I do not know.
Right, so you've already KYC'd the network.
We have KYC'd the network, and I think that is really important, right? I mean, I think that, you know, especially the frameworks that we kind of work within and making sure that the transactions are not being used for illicit behavior, like, it's just being used within Citi network. And then, you know, what we talked about, these other third-party networks that are evolving, like, how do we start thinking about transferring value to one another, right? If it's through the Fed or if it's through BIS or whatever the network is, SWIFT, whatever the network is, but again, safety and soundness, making sure that is at the forefront of what we do, because, like, just because a new emerging technology comes out, like, we have that for our clients.
There's a question about implementing blockchain technology in trade finance, which we kind of touched on. The question that I would adapt a little bit to this is it the business process within the company first that has to change to align with the technology innovation? Is that one of the reasons, I mean, you cite that as one of the reasons that TradeLens perhaps wasn't as successful as it might have been, that there needs to be internal change before there can be innovation really with the technology layers that you talk about. Maybe elaborate on that a little bit.
So we recently at Citi piloted last year Citi Token Service for Trade, where what we did was we took our tokenized deposits and pre-funded a smart contract with that. And the counterparties were a canal as well as Maersk. Maersk was the shipping agency. And then what they were trying to do was digitize letters of credit so that it didn't have to be during banking hours, it could be whenever. And in this case, when Maersk passes through the Panama Canal, that the money is automatically released, that there's like maker checkers, but instead of the paper business that it would. So now moving from pilot, into your question, into implementation and scaling. There is change management that goes on internally. It is a way making sure that, as I mentioned, that a digitized version of these letters are acceptable within the regions and like globally across. And then making sure that it's integrated into the traditional technology, not a standalone system.
Yeah, because no one's going to go through the work internally if there isn't external acceptance of the process. So it's a big chicken and egg that you're trying to navigate.
Yes.
Okay, DLT and smart contracts, could this be the infrastructure to digitize trade finance and even replace other mechanisms? Yes, no?
Yeah, definitely.
I mean, the example that you just cited seems pretty compelling.
Exactly, and like trade has been a paper-heavy business for a lot of years, and there's been numerous efforts to digitize this space. I think we all know where we need to get to, but how are we going to take those incremental steps in a way that kind of helps the industry scale? So that's and again, everything we build is based on our clients. Like we don't build in a silo what Citi thinks. It's like based on our clients coming to us saying, here's our pain point that we have. Can you help us solve? And we look to our traditional systems, but also innovative technologies that could potentially transform the way they're doing it, and work with them. Like we worked with them to get their requirements, the legalese around it, to understand could this be scalable within their institution?
We talk about the efficiency, but there's also the impact on reduced fraud too, right? Double invoicing and fraudulent billing, invoice fraud. I mean, I would imagine that would also be a byproduct, not just efficient, but also more secure.
And that's part of the technology. We talked about do you need a DLT? Do you need a blockchain? The immutable record of this technology to be able to see, was it actually paid out, and be able to track it from inception to the end is really powerful as well. Not a piece of paper in the mail, right?
I mean, who gets that? I mean, I throw away the mail. It's a shame that there is even mail. All right, here's a loaded question. How do you see AI impacting the future of payments? I mean, that's another half-hour conversation, but.
I mean, yeah, AI in itself could be another 2-hour session, but AI is, it's definitely, if you think about what is going on and the speed that it's moving, and all these different news things are coming out about cheaper, more efficient models. I talked a little bit about Treasury management and thinking about how that could, forecasting and all these different pain points that they have, and it's just really taking data in a more efficient way and giving answers, and but how do you execute against that? But it definitely could transform multiple industries.
I think it just makes everything so much more accessible. I mean, I think everyone has experienced the power of Gen AI, and I think AI is not unfamiliar to everyone sitting in this room because it's been around for many, many years. But I think the accessibility of what can be done with Gen AI, I think, is so incredibly powerful, and the sophistication of these models and the ability to really learn and experiment, I think, is so transformational and exciting. Okay, let's keep going down these. We have a lot of questions.
We have a lot of questions.
Which is really good. Why do you think so we already did that one. Can you complete the example you stated earlier? I have an account in New York that goes below a particular dollar amount. How do you actually then get DLT and digital assets to create a complete continuous transaction?
Yeah. So what we've done with Citi Token Services is it's on the back end, as I mentioned. So, as a Citi client, Karen, you say, Ryan, I want to be able to use Citi Token Services to move money between New York and Singapore. We have a handful of branches that are live right now. So New York, Singapore, UK, with additional branches coming on in the near future. So we enable it in the background. So you log on through API or Citi Direct, however you normally access your Citi account. You click, literally, you move 100 million to Singapore. It happens instantaneously. And what we do in the background is we mint the token, tokenized deposit. In New York, we send it to Singapore, we burn it. So in your account, you see cash for cash, you see USD. And that was by design because in my prior role, I had been consulting another bank that required you to convert your cash to token. So then from a risk management, from an operational, from a new account, you had additional risk around it. And clients, again, going back to the earlier statement, don't actually care about the technology.
It's confusing to people.
They just care about the utility of it. So being able to move that money instantaneously, but from a reporting standpoint, everything is synonymous to what our clients want. In the future, do I think clients may want their own wallets with multi-assets on it? But that's not where our clients are right now. And unless that they start asking us for that, we won't build it.
Well, cryptocurrency-based payments, this is a good one. Will cryptocurrency-based international payments, particularly retail transfers, eventually replace traditional systems? Ooh.
So
not to put you on the spot or anything.
No, definitely not. Well, first off, I'm currently focused more on the multinationals and solving pain points for them versus retail. But kind of to my earlier point, I think this is an alternative set of rails. We think about, as you keep saying, we keep building on top of each other. Like certain use cases, certain applicability will be better. But I think from a cryptocurrency standpoint, a lot has to change from a legislation standpoint. And, you're not seeing large enterprises really adopt massively crypto yet.
Not yet. Although Tesla made a lot of money on their Bitcoin holdings. I think I read this morning $600 million. Not a bad return. Okay, letters of credit. How do they work in this new environment with digital assets and blockchain technology? How is it different?
So we digitized it. We put it into a smart contract, the whole thing, and we made it where it's composable, like that, the clients have the ability to change based on the conditions, and then we just pre-funded it with a tokenized deposit for our use case that we built out with the canal.
CBDCs, interesting topic of conversation, particularly given the president's order not to pursue them here in the US. But that notwithstanding, what is your view of central bank digital currencies, since lots of other central banks are pursuing it, the impact of central bank digital currencies and the future of payments in your view?
Yeah, so a CBDC project was the first thing I worked on 10 years ago at R3. That was the first
10 years ago?
10 years ago was a pain point that we were trying to solve. It was with Bank of Canada and a consortium of banks at the time to be able to move money instantaneously, across it. What I've seen over time is a lot, I think there's a study from BIS, 80% of central banks are focused on this now. There's several different initiatives within this space. As I mentioned, we're involved in Project Agora. A lot of them are recreating the siloed banking system that we have today, right? Each individual country having their own kind of central bank digital currency. What is that interoperability? What is that kind of global layer across? And what are the pain points that you're really trying to solve? So, I would say, I don't know how much further we're advanced than we were 10 years ago with CBDC. And what pain point are you trying to solve with that? Regardless of what's kind of going on with the EO. I have again, I've been working on it for 10 plus years. And the technology, the use case, no one could really agree what they were trying to solve.
Wasn't it a foil to all the efforts around stable coins? I mean, I think at least in one wave, that seemed to be a motivating factor.
Yeah, definitely. I think that some countries were nervous, right? That if, their, kind of contingencies started migrating to stable coins and away from, government-based money. But we here in the US, we have, digital forms of kind of, e-money. We don't necessarily need, with commercial banks, we don't necessarily need CBDC. So it's unless there's a use case, or is it just a hammer searching for a nail type situation?
Right. Okay, I'm not sure what the yellow light means, but I think we're running out of time.
Is it going to go red? Oh, it went red.
It's going to go red. So I guess we're running out of time. I guess this is it. Well, this was really great. Thank you guys for all your great questions. Sorry we couldn't get to all of them, but we'll be around if you want to ask us after the session officially finishes. So thank you so much for your time.
Thank you, Ryan.
Thank you. That was awesome. That's great. Thank you.